Of all the subjects we've covered so far and are about to cover, none is more important than covering the disciplines for success. What's at the core of achieving the good life? The major key to the good life. The major key is not in learning how to set goals. It is not in learning how to better manage your time. It is not in mastering the attributes of leadership. Every day in 1,000 different ways, we are trying to improve ourselves by learning how to do things. We spend a lifetime gathering knowledge in classrooms, in textbooks, in experiences. Now, if knowledge is power, if knowledge is the forerunner to success, then why do we fall short of our objectives? Why, in spite of all our knowledge and in spite of our collective experiences, do we find ourselves aimlessly wandering, settling for a life of existence rather than a life of substance? There may be many answers to this question. Your answers may be different than your associates or your spouses or your friends. While there may be many answers to this question, the fundamental answer is the absence of discipline. Applying all that we know. That's the key word, discipline, self-discipline. We might add one more word here, consistent. Consistent self-discipline. It doesn't really matter how smart you are or how much you know if you don't use it. It doesn't really matter that you graduated magna cum laude if you're stuck in a low-paying job. It doesn't really matter if you attended every seminar that comes to town if you don't apply what you've learned. Better than knowledge is applied knowledge. And once we've applied our knowledge, we must study the results of that process. Apply our knowledge, study the results, refine our approach. Finally, by trying and observing and refining and trying again, our knowledge will inevitably produce worthy results, admirable results. And with the joy and results of our efforts, we continue to apply, to learn, to observe, to fuel our ambition with the positive reinforcement of continued progress. Pretty soon, we'll find that we're swept into a spiral of achievement, a vertical rise to success. And the ecstasy of that total experience makes for a life of triumph over tragedy, dullness, and mediocrity. But for this whole process to work for us, we must first master the art of discipline, self-discipline, consistent self-discipline. It takes consistent self-discipline to master the art of setting goals, to master the art of time management, to master the art of leadership, to master the art of parenting and relationships. If we don't make consistent self-discipline part of our daily lives, the results we seek will be sporadic and elusive. It takes a consistent effort to truly manage our valuable time, or we'll be consistently frustrated. Our time will be eaten up by others whose demands are stronger than our own. It takes discipline to conquer the nagging voices in our minds, the fear of failure, the fear of success, the fear of poverty, the fear of a broken heart. It takes discipline to keep trying when that nagging voice within us brings up the possibility of failure. It takes discipline to admit our errors and recognize our limitations. The voice of the human ego speaks to all of us. Sometimes the voice of ego says that we should magnify our value beyond our results. It leads us to exaggerate, to not be totally honest. It takes discipline to be totally honest, both with ourselves and with others. Be certain of one thing: every exaggeration of the truth, once detected by others, destroys our credibility and makes all that we say and do suspect. As soon as a business colleague figures out that we tend to exaggerate, guess what? They'll always think we exaggerate, and they'll never quite hold us in the same regard again. The tendency to exaggerate, distort, or even withhold the truth is an inherent part of all of us. And only an all-out, disciplined assault can overcome this tendency. It takes discipline to change a habit, because habits are formed a little bit each day, every day, every day. Once habits are formed, they act like a giant cable. They act like a nearly unbreakable instinct that only long-term disciplined activity can change. We must unweave every strand of the cable of habits slowly and methodically, until the cable that once held us in bondage becomes nothing more than scattered strands of wire. It takes the consistent application of a new discipline, a more desirable one, to overcome one which is less desirable. It takes discipline to plan. It takes discipline to execute our plan. It takes discipline to look with full objectivity at the results of our applied plan. And it takes discipline to change either our plan or our method of executing that plan if the results are poor. It takes discipline to be firm when the world throws opinions at our feet. It takes discipline to ponder the value of someone else's opinion when our pride and our arrogance leads us to believe that we are the only ones with the answers. Discipline is a constant human awareness of the need for action and a conscious act by us to implement that action. Discipline is an awareness of the constant need for action and a conscious act to implement that action. If our awareness and our implementations occur at the same time, then we begin a valued sequence of disciplined activity. Now, here's the other side of discipline. If there's considerable time that passes between the moment of awareness and the time of our implementation, then that is called procrastination. Doing it tomorrow instead of today. Procrastination, an almost exact opposite of discipline. The voice within us says, get it done. Discipline then says, do it now. Do it to the best of your ability, today, tomorrow, and always, until finally the worthy deed becomes instinctive. Procrastination says later, tomorrow, whenever I get a chance. Procrastination also says, do what is necessary to get by or to impress others. Do what you can, but not what you must. In every circumstance we face, we are constantly presented with these two choices. Do it now or do it later. Discipline and procrastination. A choice between a disciplined existence bearing the fruit of achievement and contentment, or procrastination, the easy life for which the future will bear no fruit, only the bare branches of mediocrity. The rewards of a disciplined life are great, but they're often delayed until some time in the future. The rewards for the lack of discipline are immediate, but they are minor in comparison to the immeasurable rewards of consistent self-discipline. An immediate reward for lack of discipline is a fun day at the beach. A future reward of discipline is owning the beach. For most, we choose today's pleasure rather than tomorrow's fortune. So how can you get rid of the easy distractions? How can you keep your mind on what you're trying to do? How can you keep an attitude of doing it all and doing it now? How can you make the choice of discipline over procrastination? How can you stay focused on your ambitions? How can you avoid conversations at the water cooler? You can keep your focus on your work. You can get it done today instead of tomorrow. You've got to really work on your consistent self-discipline on a daily basis, or you'll find yourself distracted. Distracted by negative thoughts, distracted by negative people, distracted by water cooler chatter, and pretty soon, depending on the type of people you've associated with, distracted by your doubts within yourself. Never underestimate the power of influence and associations, and never underestimate the power of your own consistent self-discipline. Now let's take a closer look at discipline. True discipline is not the easiest option. Most people would rather sleep until 10 o'clock than get up at 6. It's easier to go to bed late, sleep late, show up late, leave early. It's easier not to read. It's easier to turn on the television than to open a book. It's easier to do just enough than to do it all. Waiting is always easier than acting. Trying is always easier than doing. Imagine what life would be like if we didn't have to make our bed in the morning, or keep our garage clean, or pay our taxes, or show up for work tomorrow. Wouldn't it be fascinating if we didn't have to do these things? Wouldn't it be fascinating? What do you suppose would become of us? You're right, not much. For whatever the reason, The system we live in and contribute to is designed to make the easiest things in life the most unprofitable. Profitable seems to be the most difficult. Our world is and always will be a constant battle between the life of ease and its momentary rewards and a life of discipline and its far more significant rewards. Each has its own price, the price of discipline or the price of regret. We will pay one or the other. What we wish we had done is the voice of regret, speaking in a sorrowful tone at a time when there is no going back. This is regret. No second chance. No, what would I do differently? Choose one or the other, but both will have their price, the price of discipline or the price of regret. One costs pennies, the other a fortune. Dostoevsky said, "There are hundreds of young men who would die for the truth, but very few who would spend 5 years studying to know what the truth is."
So good evening, everyone, and welcome to another session in PIP Tips and Profits. And this evening, we'll be looking at technical analysis, right? Now, the outlines of the topics for this evening is technical indicators, where we'll be looking at the Fibonacci retracement tool, though it's not necessarily classified as an indicator, but it is still a projection tool. And any projection tool, we classify that as indicators, simply based on the fact that it gives you forecasted direction or forecasted target points out of the market. So it can give you an indication as to where a reversal may take place in the market or where a continuation may occur in the market. So we'll be looking at that. Another indicator that we'll be looking at is the exponential moving averages, right? And with the exponential moving average, I'll be using mainly just one, and because I'll utilize just one to give context of the purpose of the indicator and how you can utilize it to apply this to your trades to give you a better confluence towards your trading decision as you progress throughout your entire trading journey, right? So all of them, irrespective of the type that you use, it is basically giving you the same information, and we'll explain that. We look at trade journaling to let you know that this is probably one of the most important parts of your trading journey, and that's to document your process, right? The only thing that you would have are in terms of recollection, the only proof of you taking a particular trade is done through your journal. Yes, your trading account may show you the results and may show you where you enter and where you exited the trade. However, your trade journal will give you more details and insights about your trade. So when you document your trade, you will document the thought process, the reason, all these things you would document in your journal. So 5 years down the line, you can review that and you have a framework on which you can build and improve yourself as a technical trader. We'll be looking back at risk management and mainly sequential trading. Now in this section, it will be a little bit different than what we know about risk management, right? Because when we look at it, we'll be looking mainly at sequential trading, taking your trades in strides. No one trade should be detrimental to you, meaning that the result of one trade, whether it be a win or a loss, it should not affect you in the grand scheme of things. So when we think about our trading journey, and there's a 50-50 chance that you're going to win a trade and you're going to lose a trade, it's the same principle right across the table. What can go for you can easily go against you. However, in the sequence of trades, you're looking at the number of times something can go for you versus the number of times something can go against you. And even though we're looking at that as a 50-50 rate as well, through sequential trading, you can see just how easily you're able to make consistent profits, right? Then we're going to do top-down analysis. And in top-down analysis that we'll be doing this evening, we'll be putting everything that we would have learned so far, putting that to practice. So we'll be looking at utilizing our support and our resistance areas. We'll be looking at utilizing the Fibonacci. We'll be looking at utilizing exponential moving averages. We'll be looking at utilizing our trend anchors. We'll be looking at observing the trend. All these things we're going to put in place. And you will see how easy it is when you utilize all of these technical techniques, then you will see how much it will affect your trading in a positive way. And finally, we'll do some sample trades in terms of paper trading. All right. So as always, if you have questions, post them in the chat and or write them down, and you can send them to me in an email, or you can send them to me in a message in the trading room. All right. And I'll be more than happy to go through it and have a full discussion with you on that as well. All right. So let's get started with the technical indicators. And in specific, we're looking at the Fibonacci retracement tool. Now, in trading, the Fibonacci retracement tool is used to help a trader identify potential areas where the market may correct or pull back, right? In association with Dow theory, when we look at the trending market environment, based on what Dow theory utilizes or observe through his theory, is that the trend may move or correct at about 40 to 60% of the original move before resuming in that trend. When we apply Fibonacci to that, now, we're realizing that this retracement is generally between about 38.2 to 61.8%. So we still essentially get back that same 40 to 60 rule based on that Dow theory analysis. But trend utilizing Fibonacci gives it a little bit more context, or I give it a little bit more precision, right? Now, there are other values that we have on the Fibonacci tool, and they are also important factors in terms of how the market behaves. So, for example, the 78.6 level is used to determine the strengths of Elliott wave theory. In a sense, wave 2 generally corrects at about 78.6% of the first impulsive move. The 161 and the 127.2 extension levels, those are generally utilized to identify the ending of wave 3. And you have further extensions in terms of the 261 and the 361, which gives you another indication of target areas towards the ending of another impulse, right? And these are utilized with the Fibonacci retracement tool and the Fibonacci extensions, right? So these are the things where you know can utilize your Fibonacci in order to give you a target or a projection out of the market, right? When utilizing your Fibonacci, what you want to do in terms of how you want to identify that and how to utilize the tool properly is, if you look on the chart and you're seeing the market making a move to the upside, you're able to identify that we have a trending market behavior taking place here. Now, based on Dow theory, again, it's 40 to 60. Fibonacci, 38.2 to 61.8. So from here on out, we're really going to be focusing on the 38.2 and the 61.8 levels. right? To get an indication as to where the market will correct, you put your first point of the Fibonacci tool at the starting point of that move that you're trying to get the information on. So from the first point goes to the start of the move. So for the bullish retracement, if you want to get the bullish retracement, you would put the Fibonacci at the base, the start of the market in terms of support, where the move started. The second move goes at the ending point of the move at the top. This would become the 0, and you would have 100 here. Then you would start to observe, you would identify the 23.6, which is a shallow retracement level, right? You would look at the 38.2, and you would look at the 61.8. Now, based on this diagram, what I want you to observe is to identify how the 38.2 levels are basically around those same pivot points in the market that you would be utilizing as support and resistance levels, right? So this here we would have as market support line going through here. But if you observe on the pivot points, you would find that is where you have your support and resistance. All right, and the 38.2 lands there nicely. If you also take a look, you would find around the 61.8 level, you're also seeing market pivot points around these areas, and they generally fall around market support. So if you observe, you will realize now that if you do understand and we learn to draw the basic technical data or plot the proper lines on your chart, applying the Fibonacci tool would make it a little bit easier for you. So to give your area confluence, and that's really what you're looking at. So let's say that you are also looking at this area as market support. So you're anticipating price to push higher out of these areas. And when you look at the chart and you pull your Fibonacci tool out, you're also getting that that area is a point of reversal in terms of the 38.2 levels. So you can execute your trades there because you now have two confirmations of price pushing higher. You would ultimately look again for your third confirmation. Could be the fail close. There's no price acceptance below that area of support. So this would be another third confirmation for you. Failure for the market to close beneath that particular area. There was price action beneath, but no price acceptance. So that's a third indication to you that price is pushing higher. And as you can see, the market did in fact push higher. Now, the price came back into this area and also gave you another pin bar rejection, indicating further bullish strength out of that support zone. So you could easily now have 4 indications to you that price is projected to push higher. All right, so this is what you want to utilize around your Fibonacci levels, or how you apply them in relation to your support, your resistance, and indeed your trending areas. In this particular case, you can see again the market observe around the 61 areas and also market support. You find strong bullish movement coming into the market, but every time price failed to close around those areas. Ultimately, with this pin bar move, you also get what? A bullish engulfing candle coming into the market. All would indicate further movement to the upside out of this pricing, right? So these are some of the things that you want to look at. here, based on what we just saw out there on the previous movement, you can see ultimately the price did in fact move higher, right? And remember, these are live market data that I just simply screenshot to utilize as a reference point to demonstrate the usage of this indicator. So here you would find that same rejection candle, failure to close beneath that area. You find again that pin bar correction coming in. So had you entered at the price getting above that area and you keeping your support zone, your stop loss below that support zone, you would have find yourself executing a well-conditioned trade with 4 confirmations indicating further bullish price action, and ultimately you would have found yourself in a winning trade. All right. The next technical indicator that we want to look at is the exponential moving average. All right. And the moving average is a calculation of a series of price over a specific period, and it provides the average of the full set. So an exponential moving average is a type of moving average that places a greater weight and significance on the most recent data point, right? As technical traders, we can utilize moving average to quickly identify market trends and also support and resistance levels. So utilizing this tool, essentially what it is doing is looking at, to simplify things, let us say that a candle has 4 data points on it, right? It has the high, the open, but let's say that this is a bearish candle, the open, the low, and the close. So we have 4 data points. Let's say that the highs of the market was 100. The open of the market was 90 or 90. The close of the market was 75. The lows of the market was 65. So what you find happening now, 5 and 5, that's 10. This 9 and 1, 10, and 7, 17, and 6, that's 23. So you'd have a total of 330 points, and you divide that by 4. 4 8s, that's 32, and 4 5, that's 20. So the average price for this particular candle would have been 85. And the moving average is going to give you a point on the line that measures 85, right, in terms of price, because this would be $85. It's going to give you that average price. Now, this is if it utilizes 1 candle, then it is giving you the average price for 1 candle. If we're looking at 10 candles, then it is giving you the average price of those 10 candles. So it would have candle 1 as an average price of 85, candle 2 as an average price of 80, candle 3 as an average price of say 75, and you go on and on and on to candle 10. Now, when it does that, it's going to add up the average price for all 10 candles. And then once it gives you the average price for all 10 candles, then it gives you once it gives you the total, it gives you an average of all the 10 candles and put a point on the chart. The next candle that comes in the sequence, so let's say you have 1, 2, all the way up to 10. Right, the next candle would become 11. So it's going to use this and then go back 10 candles. So it's going to ignore candle number 1 and start with candle 2 to 11. That's still 10 candles, and it's going to give you the average price of those 10 candles. Then when candle 12 comes in, what will it do? eliminate candle 2 and start at 3 to 12, 10 candles, and it keeps moving in that manner. So as price with the exponential moving average, it works a little bit different. But this is pretty much the same basic principles on how the moving average targets and tallies the price. All right. So for the exponential moving average, it puts more weight on the significance of the most recent data point. So as price moves, whether by the pips or any movement, small movement out of price, it is automatically recalculating that data and moves the price with you. So as price moves, as the market moves through price, the moving average tries to recalculate quickly and moves with it as well. Right? And that's really what the exponential moving average does. That's one of the advantages of that. So in this situation now, as the average price moves higher, right? What is it going to, what are we expecting? If this is the average price, right? All these data points here, as the market pushes higher, you're seeing that the average price is what persons are willing to pay. That's essentially what the moving average is giving you. An indication of the average price traders are willing to pay. So when the market is above the moving average, it is indicating strength to the upside, giving you a trending market higher because the average price keeps rising. So as the market comes back into this moving average here, it is telling you that buyers and sellers are willing to pay this average price. So more buyers are coming in at the average price. So think about it. If you go to the supermarket and you're looking to buy bread, right? And if at some point in the season, bread or flour became scarce in terms of you have flour in short supply. So demand for flour increases. The price for flour also increases. And the bread price will also increase. So when you used to pay, let's say, $300 for a loaf of bread, and now you start to pay $500 for that loaf. Now the price may fluctuate between 400. At one point, it may be at 350. At one point, it may be before the price start scarce, before the bread became the flour became scarce, you may find price at about 280. Now it's going to add all these different prices for bread, and it's going to average it off and say, hey, let's say at about $320. This is now the new normal for bread price, because we're no longer comfortable, or we're no longer looking at a $300 bread market because flour is still scarce, but $500 is just too expensive. So how can we get the price down a bit, right? And then now looking at how nobody is willing to buy bread at 500. So let's say that this is a bread market and here was 500. And if everybody's here saying that price is too high, they're not buying bread for $500. They're looking to buy bread cheaper. So the market now would have to say, hey, there's nobody buying bread here. We can't keep the price there, or there's no money for us to make. Nobody's buying. So they lower the price a bit and they come down into that area. But the average price for bread here was about $400. Nobody still wanted to buy. So they said, okay, let's lower it some more. And now we're coming into what the overall average price is for the past, in this case, this is a 200 period moving average. So for the past 200 days of trying to sell bread, the average price persons were willing to pay was about 320. So now we come back into that average price of 320. And you find, okay, no buyers are comfortable. So they start to buy bread again. And the market progressed back higher. So that's a simple example of how price is working. It's the same thing with exchange rates. So if you're looking at the euro dollar in relation to the US dollar, and you're saying that the exchange rate is $1.30, and they think that exchange rate is too high, nobody is going to want to spend their US dollar to buy the euro dollar at that rate. So they have to find some way to get the euro dollar lower. And how do they get the euro dollar lower? By injecting more money into the market, increase the supply. And this is what institutions do on a regular basis. And this, if you remember, the first thing that we did in terms of understanding the Forex market, we said that the central bank is at the core of everything in terms of money. They understand and know what the average price traders or buyers and sellers are willing to pay. If the value gets too high and nobody is willing to buy or exchange money at that particular zone, then they now have to come in and flood the market with money. If you flood the market with money, that means they now are offering the money at a more convenient rate. Now, how do banks flood the market with money? They lower interest rate. So if the interest rate was 10% and they lower the interest rate to 3%, this is what is offloaded to the banks at 3%, because the banks now only need a 3% increase in order to pay back the Federal Reserve Bank or to pay back the central bank on their on the money that is being liquidated to them. They now can offload that interest rate to you, the consumer, giving you more reason to come and take out loans. So you can get to take out a loan for 6%, and you find you're getting a loan, a motor vehicle loan at 6% interest rate, and not you go to another bank and they're trying to compete with you for that loan, and they say, okay, I'll go to 5.8%. I'll take an entire interest percent off. So because the money is in supply, everybody wants to get rid of the money. They want to put it out there. So they have to offload it. And the only way to offload it is by making it cheaper. So this is a cycle and the process of money and how it works. So the moving average gives us an indication of what that average price is. So how do we utilize it? We utilize the moving average in association with our support and our resistance lines. We also utilize them with our trend line as well, our trend anchors too, right? Because if you observe where this moving average is located, you realize that the market has multiple pivot points, support and resistance lines around that area. So it's giving you now an indication that this area is a strong area of value. It is indeed working in conjunction with what your analysis would have provided you with in the first place. So what you realize now is that the moving average, it's like having a cheat code for the games that you're playing. It's like having that little angel on your shoulder to nudge you in the right direction. But you still need to do the work. You cannot rely solely upon the moving average, because as you can see, price can easily break through the moving averages, the same manner in which price can break through the support and resistance zones. So it is best to observe the market based on the fundamentals and the principles that you would have acquired and the knowledge that you would have acquired throughout the duration and the process of this entire course. And you utilize these in conjunction with what you already know. So the moving average provides you with a better alternative towards executing your trades, or to give you added confluence towards executing your trades, right? So both the moving average and the Fibonacci tool, you realize that both of them work in conjunction with your own independent analysis. Now, there are multiple indicators out there that you can use for the purpose of this course, because the aim is to get you into becoming technical traders. And being technical traders, you rely mainly on the price and your technical analysis. I only focus on just two. Now you can take the time, you can find an indicator that you like, you can research on the process of how the indicator operates and the context by which it falls into the market and what it forecasts for you. And you utilize those indicators along with your technical training that you would have developed here. And you put that together and you observe to see how the market operates and how you're able to develop a trading strategy and a trading plan that would work wonders for you. And that's ultimately what you want to be doing as a technical trader. Right? So the next topic that we're going to be looking at is trade journaling. And an essential part, in fact, if we think about it, like I said, what really is trade journaling? Sorry about that. Now, when we think about trade journaling, it's the same as having a diary, right? Now, if you have a diary that you write your thoughts in, maybe you write poems, whatever it is that you write, you document your thoughts as you progress through life, right? Trade journaling is the same. You document your thoughts as you progress through your trading. So an essential part of any successful trader is based on how we are able to organize, plan, and prepare for every trading session. Journaling your trades is the process by which a trader documents each risk that is identified, along with the areas of interest where the value proposition is at its best, meaning you find a high probability trade. When you organize your trades, you include a few things in that. In terms of your bias, meaning what you're really thinking, whether or not you're looking at weakness or strength out of the market. What is the overall market decision? What is the reason for your bias? What are your confirmation levels that you utilize in arriving at this bias? What is expected entry levels that you're looking at in the market? All these are things that you would include in your journal. There are a lot more inserts that you can put in your journal as well. Now, this is a nice example that I put together to show you just a little portion of what my journal would look like. Now, in all honesty, I could not get to fit everything on one screen, right, to share with you the fullness of what the journal is. But this I believe is well sufficient to give you an idea of the thought process that goes into every trade that I document or that I put out in the market. And this was an actual trade that I took, right? So if you look, I have on my journal here, I identify the pair. I also have dates on it too. So I identify the date, the trading date. All right. So I know the pair. I look at the bias. I was looking for a long opportunity. I identified my key support level as 67.34, my key resistance level as 71.27. I was looking for a buy limit trade. The entry time frame was on the 1 hour chart. The entry was at 68.35. The stop loss was at 67. The take profit at 71.25. So if you look just from this and my overall reason for bias, overall market is in a downtrend on the daily time frame. However, I am seeing a confirmed counter trend that is also active on the daily, anticipating a push into key resistance level, placing a buy order off the current pullback around the 4-hour uptrend anchor. So immediately I know exactly what I did on this particular trade. So if I should bring up this trade to anybody and they said, so why you took that trade? I can say, market was in a downtrend, saw the confirmed uptrend, and I saw the confirmed trend as well, counter trend. I realized that the market was in a pullback around the 4-hour uptrend anchor. So I anticipated a push into key resistance. And that's all I did. Now, what is the entry that I took into the market? I put an entry in the market of 68.35, right? My stop loss was at 67. What's a key resistant? Key support zone. I was looking to buy. So my key support zone was 67.34. My stop loss was 34 pips below that key support zone. So if the market got beneath key support, I would be out of that trade. What is the key resistance level? 71.27. What is my take profit level? 71.25. I put it just about resistance. Didn't need to put it at the exact point because market, the resistance area is a zone. Right? And we may not get to hit that exact target point. So for this particular trade here, I was risking 135 pips. What was my reward for this trade? 67, that's 300, 400, that's 425 pips. So 135 to 425. That was my risk to reward ratio. So immediately I was risking 1, and this is a little more than 3. So this is about 3.1, 3.2, thereabout, right? But that's really what the thought process behind the trade would have been. And you do this for every single trade that you place, because you want to be able to review any mistakes that you would make out there in the market. Now, granted, at the time of this entry, this was, I believe, a start of a new trading week, and this was the first trade that I put out. So I did not have the results at the time that I put this presentation together. So I did not utilize it here. I also include in my journal, I have a section for my profit and loss, right? I have a section for all of that too. So I have my P and L section for that. I also have a section for where my trade adjustment, right? And this trade adjustment takes into consideration my take profit levels in terms of partial profits, at what price I'm taking partial profit, and at what lot size I am closing out those profits, right? So these are all the things I put in place in my journal. So this is really what we want to look at. The next thing we want to touch base on, and let's see if it's sharing now. Always have issues. always have issues when I try to share my whiteboard. All right, so let's resume share and see if I will get it up. Share. Okay, whiteboard, let's try again. Okay, now we have it. Always have issues whenever I try to share my whiteboard. Now, the whiteboard is used to explain sequence trading, right? And what is sequence trading? When we think about trading in sequence, we're thinking about in relation of probability. This is what trading is all about. This is what most persons do not share about trading. Everything we do in trading is based on probabilities. Nothing is ever 100%. There's always a margin for error. And if there's a margin for error, that means everything in trading is at least or at most 99.99% accurate. Everything. This is the most level of accuracy that you can get. And that means you have a margin of error of 0.01%. This margin of error can occur at any given time in the market. Most traders don't even have this level of accuracy. So we can strike that out too. Right? So thinking about things on a realistic level, we are saying if we look at the market, there's always two outcomes to every situation. There's always two outcomes. Why? For every trade that you take, it's a double action. There's two processes taking place for every time you execute a trade. Now, what are those two processes, if you remember? For every position you open in the market, there must be a buyer for that sell trade that you want to place. So if you're looking to go long, you are looking to buy. On the other side of your trade, you have a trader that is looking to go short. So they are looking to sell all the time. So every transaction take place in trading for an equal but opposite conviction. Every transaction in trading takes place for an equal but opposite conviction. You are looking to buy. So if this value here is, let's say that we're looking at Euro USD. And in this case, we're looking at the value here at 1.1264. When you buy one standard lot here, you are looking to buy because you are getting equal value here to say price is currently low and the market is you're anticipating the market to push to 1.1265. At least that is what you're saying. You're looking for price to go higher. Now, at this stage, the person that takes the other side of your order, the short order, they're anticipating the market to push lower. And they are anticipating that they are getting out of this position for a profit now, so that they can buy when the market moves lower to 1.1263. Now, who will ultimately make the move to win that trade? This has nothing to do with what we are looking at on the market. This has nothing to do with what will happen around support or resistance level. It has absolutely nothing to do with any of those things on the chart. This is all about one key thing. This is one thing we want to remember, that the market is based on a belief system. I believe the price is going to go higher, so I buy. I believe the price is going to go lower, so I sell. The direction of the market will ultimately be dependent upon the spending power of the buyer versus the spending power of the seller. That's one. The conviction of the buyer versus the conviction of the seller. If you notice, I input nothing about the chart. So in essence, we're really going back and eliminating everything that we pretty much learned, right? But we're not really doing that. We're just trying to let you know what the thought process of smart money is doing and what the banks are doing in terms of trading. Is they are not looking about what is going to happen in this particular trade. They see an opportunity to buy, so they buy. They see an opportunity to sell, so they sell. One trade is the outcome of that buyer or seller's conviction, which is a 50-50 opportunity, because we do not know who has the stronger conviction. So how do we profit from not knowing? The one thing that we know for certain is that there are two outcomes to the trade. You're either going to win or you're either going to lose. So if you take one trade, you have two outcomes. And what are those two outcomes from that one trade? You have one win, one loss, or better yet, I think I made an error there, because there's actually four outcomes out of this. If you take one trade, that's what I wanted to say, sorry. If you take one trade, there are two outcomes for that one trade, right? You eat that one trade can either be one win or one loss. Those are the only two outcomes out of that trade. So how much percent chance you have of winning and losing? Your chance of winning is 50-50. Right? Chance of winning is 50-50. If you take 2 trades, right? So the chance of having a favorable outcome, which is what I want to say, is 50-50, right? If you take 2 trades, what are the possible outcomes that you can have? And if we look at them, you can have 1 win, you can have 1 loss, you can have 2 wins, and you can have 2 losses. So how many outcomes are there out of this trade? You have 4 possible outcomes. So your chance of winning now is 4 divided by 100, which is 25 to 75 or 75 to 25. Favorable in either direction based on the number of outcomes that you have. If you look at the number of favorable outcomes that you have a favorable outcome would be 1 win, 1 loss, or 2 wins. 2 loss is not a favorable outcome for you. So if we're observing things based on favorable outcomes, then that's not what we want to see. Your favorable outcome here would be 3. So you now have a chance of 33.34 to 66.67. Those are your favorable probability of having a success after 2 trades. If you take 3 trades, what are the likely outcomes? You can win 1, lose 2. So that's 1, 2. This is 1 outcome. You can win 2, lose 1. That's another outcome. You can lose 3. And you can also win 3. Is there another outcome that you can have there? All right, look and tell me if you can have another outcome. Just give me a 1 if there's another outcome that can happen out of this trade, or if this is all that can happen from you taking 3 trades. All right, so when you look at this scenario, you also have, let's see, just to make sure, 1 win, 2 loss, that's 2 trade, 1 trade, 2 trade, 3 trades, all right, and 4 trades. So you also have 4 possible outcomes out of the market with 3 favorable conditions, right? So again, you increase your chances with this to the same. The more trades that you take, it increases your chance of winning in terms of getting a favorable outcome. So it's the same thing to say that out of every time as the higher the number goes, it will reach a point, and I don't want to spend the time to go through all of this, right? Because it will take a lot of time, right? But if we continue to go through this stage and we look at even 4 trades, right? And you look at the possible outcomes out of the 4 trades, ultimately it will take you back at about 50-50. So what this is telling you is that as traders and utilizing sequence trading, you want to trade in terms of trade 1, trade 2, trade 3, trade 4, 5, 6, and so on and so forth. You want to put probability in your favor across each trades. So if trade 1 is a win, you want to make sure that the average wins is greater than the average loss. So this is where risk management comes into play. Remember, when we talk about risk management, we said that what? Every situation must have a return on our investment, a potential return on your investment. So if you have 1 and you're getting back 1, there's no return on your investment there. You're literally getting back what you put in. If you risk 1 and the return is 1.1, then all you're getting is 0.1 on top of your investment. The higher the return, the higher the return, the more favorable conditions you are looking at, the more money you get. So when you have a trade, and I say the minimum that each trade should deliver is 1 to 2. So you get 2 times your investment. So if you risk 2, you get 4, and so on and so forth. So here, if trade 1 was a win, then trade 1 would equal to 2. If trade 2 was a loss, then trade 2 would equal to -1. If trade 3 is a win, then trade 3 would equal to +2. Trade 4 -1, trade 5 -1, trade 6 -1. These are all losses. Trade 7 -1, trade 8 +2, trade 9 +2, trade 10 -1. This is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So after 10 trades, you would have had 1, 2, 3, 4, 5, 6 losing trades. Those 6 losing trades out of 10, that's putting you at a 60% loss. Those 6 trades would equal to a total of -6. You would have had 4 winning trades. So you'd have had 1, 2, 3, 4. 4 twos would be 8. So you would have had +8. So at a 60% loss after 10 trades, your total investment would be +2. So you realize now that as you progress through trading, the outcome of one trade is irrelevant in the grand scheme of things. All you want to make sure is that you are trading in sequence. Now, there's key things that we need to remember when we think about trading in sequence. Every trade 1 must be equal to trade 2, which is equal to trade 3, which is equal to trade 4, equal to trade 5, all the way to trade 10. Each must be equal. If you realize, I risk 1 to get 2. Now, the 1 that I risk can be 1 would equal to 1%, or this could be equal to $2. It could be equal to 3%. It could be equal to $4. Now, how you choose to apply these percentage can be done on a fixed rate or on a reducing rate. If we're working on a fixed rate, then trade 1, if you have, let's say you have $100 in your account and we're using 1% per trade, 1% of $100 is equal to $1. So trade 1 would equal to minus 1, would equal to plus $2. Because you would have risked $1 and you got $2. All right? Now, trade 2, which was a loss, you would now have $102. No, this is a fixed rate. So trade 2 would be equal to the same 1%. Right? And that 1% is $1 right across the board for all 10 trades. Right? So every trade that you lose, you would have lose $1. Every trade that you win, you would have win $2. Right? So that would put you at a total of plus $2 at the end. Right? We did the math just earlier. Now, if we were working it now on the other side in terms of working it in terms of a reducing rate or on the reducing balance, right? And it would be reducing or increasing balance, just for clarity, right? $100 here, and you have trade 1, which would be equal to $1, which you won that trade. And that trade would have plus $2, which would give you a new balance of $102. Trade 2 was a loss, $1. It would be a loss of $1.20. Or $1.02, sorry. Right? Minus that would leave you with $101.80. Let's just do the math real quick just to make sure that I have the numbers correctly. All right? So it's $102 times 1%. Yes, $100.02. Some of the time, these are the smallest things that give me a problem, small numbers, right? So it would be $100.98. See, already made a mistake there. So it would be $100.98 that you would have had here. Trade 2 or trade 3 would be at a loss again, which would be at a rate of times that by 1%. Roughly $1, right? So let's put that now, just say $1. Which will bring down your balance to $99.98. Trade 4, which is also a loss, would be down to 98 cents or 99 cents. So you find that each time you go down, you reduce the size of the amount that you work out, right? Because you're looking each trade at 1% of the overall balance on the account, right? Now you can work this out now to see exactly how it would reflect on your overall trading account at the end of the day, right? So essentially, what you're trying to identify is what your average wins and your average losses would equal to at a worst case scenario. Now, what I generally recommend is to say if you're starting with a small trading account of, let's say, about $200, which is what we use for the trend and wave strategy, right? I say we risk a fixed amount of $7 per trade. That's a fixed amount that we use, $7 per trade. Now, the return on this account is minimum $15 per trade. Minimum. That's what you get back, right? For every win or for every trade that hits take profit. That's what you return. That's what the return is, right? And all we need here, this gives you at a total of every trade that you take. If all trade were to be losing trades, then it would give you a total of 28 trades. So that's really what it would give you, a total of 28 trades. So what you have now utilizing this trade sequence, if we're looking at trade 1, 2, 3, 4, 5, 6, 7, all the way up to trade 28. Based on trading sequence, we are to win an average of 50%. That's on average. But what we understand is the laws of probability declares that even though the expectancy is equal to 50%, the outcome can be plus or minus 50%. So you can get 60%, 80% win, 80% losses. You can get 90% win, 90% losses. We all know 100% loss would pretty much wipe out your account. We already understand that. Because if you lose all 28 trades, then it would eliminate the account. 100% win, well, we can look to see how that would actually impact the overall account, right? But if we should run the numbers across the trend and wave strategy, which is what we will be getting into in the next session, and ultimately trying to show you why we say this strategy is foolproof and you cannot lose from that. So let us say that you have a $200 account that we're starting with. And we are going to observe based on that strategy through the process of sequence trading. We take a total of 28 trades. At the first end of that 28 trades, if you take 28 trades and you lose 90% of those trades, it means that you would have lost 25 trades and you would have won 3 trades. All right, so at 90% loss. Now, what sort of effect would that have on your trading account? If every losing trade equals $7, $7 multiplied by 25 would be equal to minus $175. You would have won 3 trades. So 3 times 15 would have equal plus $45. So here you would be down at $130, leaving you with a total of $70 in your account. That $70 allows you to take 10 more trades. We are familiar with that. So at 90% losing rate, you're able to take a total of 38 trades on your trading account. If you have whatever happens on one side can also happen on the other side. So if you have a 90% win, that's 25 trades multiplied by 15. You now have, and this is your wins column, you would now have $375 minus 3 trades that you would have lost, which would be 21. So you would have earned $354 on top of your $200 investment. So a 90% win is actually equivalent to 154% increase on your overall investment. Not 100, and that's not 154. I am so sorry for that figure. It's not 154%, but that is about, yeah, let's work that out. All right, so we're looking at about 75% increase on top of our overall investment. That's really what we're looking at this stage, a 75% increase on your investment, because you would have gotten $354 in return overall on your investment. right? So this is what your new account balance would look like. Now, if we lose, so again, at 90% loss, you're looking at that. If you win 50% of the trades, which is the expected result of the strategy really is 65%. So let's work that one out first, right? So 65% of your trades which would equal to you winning about 18 trades, right? And if you win 18 trades, you're losing 10. So you're losing $70 in comparison to winning $270. Oh, yes, I was right. So you're in at 65%, you're getting an additional $200 on top of your overall money. I was right here. It was about 154%. I was making an error with my calculation to say that this would have been the increase, the new account balance. But in truth and in fact, the new account balance would have been $554, which indeed would be about 154% increase on the overall investment, right? So here you would actually at 75%, at 65%, you're actually doubling your overall account. If you win at 50%, if you win 14 trades, and you lose 14 trades, you would end up with a total of $112. So this increases your account. 50% win increases your account a little bit more than 50% on your account balance. And this is the power of sequence trading. So this is a prime example of what it means to trade in sequence. So if you make sure that every single trade meets the same requirements, meaning you enter entry is equal to your stop loss and take profit, right? All for trade 1 all the way to trade 28. You are taking identical trades. So the outcome of one trade is irrelevant to the outcome of the other trade. And whether or not you're applying this to the trending wave strategy, or you're applying this to the strategy that you decide to trade with when you start to trade independently, right? And we are providing you are learning everything that you need to learn about the market now in terms of the key fundamentals of how the market moves through its support, its resistance, and its strengths. Everything else in the market is an addition on that can be used in conjunction with all of these things. So when you observe based on all the different indicators that may exist out there, we're always bringing it back to the support, the resistance, and the trend that the market is in. And that's what we're doing, right? So if we do some top-down analysis and paper trading for this pair, right? And here we are going to look for entries on the 1 hour time frame. And if we are looking here on the daily time frame now, and if we observe what the daily time frame is indicating to us, and we are saying that when price is above the 200 moving average, here we are looking, when price is above, we're looking for longs. When price is below, we're anticipating a fall in the market's direction. right? Or we're looking for downtrending environment. If you also observe what is taking place here, and we look at the lows of the market here, and you look at the highs of the market here, in relation to the highs and the lows are more recent than the highs of the market. So if the highs are to the left, then we are looking at a downtrending market. If the highs are to the right, then we're looking at an uptrending market. So that's a rule of thumb that you can use. If the highs is on the left, we are looking at a downtrend. If the highs of the market is on the right, we're looking at an uptrend. Right? So from here, this is the trend that we would be observing. We would have been able to identify our trend anchor there, which was invalidated with price quite a few times. And we're looking at our trend anchor here, which the market respected superbly. So now that we have an invalidated trend anchor around this area, this level now act as the market's trend anchor. So we no longer have an active trend anchor coming from this area. We now need to find one on the other side. And if we look at price, there's nothing here for us to identify a trend anchor. So we are now looking at these areas here to become market support and resistance, and this is your overall trend anchor. All right, so there's no potential anchor in the market, but we actually have a trend anchor to identify ourselves with. Right? Now, when we observe what is taking place on the daily time frame, we're in a downtrend. We have the trend anchor here. Price is below the moving average. So how would you document and journal your trade? Daily time frame is showing you price rejecting the 200 period moving average. We also have what can we observe here again? If you look at this and tell me what you're seeing, you're also seeing two bearish pin bar candles coming out of the market there. So if you observe the lows of the market here, and you observe the highs of the market there, if you're taking a trade on the daily time frame, we could have easily executed a trade from this level, holding it back to the lows of the market. All the way down there. We have a risk to reward that is greater than 1 to 1. In fact, this is 2 to 1, 2.3 to 1. Right? So we could execute a trade in that sense. But this is if we're looking at just the daily time frame. Now we're doing top-down analysis. So this is what we observe here on the daily time frame. The next thing we want to identify is our support, market support, and market resistant areas. This level would be ideal to anticipate market resistance. The trend the moving average is there too, in association with these pivot points here. So that is already market support, market resistance. If we look at market support, we can identify multiple pivot points out of the market around these areas. All right, so let's look. Can put them around these areas, right? And these now become your market support zone. So pretty much where we are now in price. So this is what you would have observed on the daily time frame. This is all a part of your technical analysis. If we look at this move here and we observe to see what the correction of the market is. Now we're looking at a downtrend market. So if we take the impulse here, we start, it's always the Fibonacci tool is at the start of the move. And we place the first point there. And we take it down to the end of that move. And we highlight our 61.8% area. Now you find that area is also within that same support and resistance level. So if you look at the 61.8 and we draw the line on that level, let's delete this box so you can see it. So this line is your 61.8% level. We can color that red, right? That's your 61.8 level. And the market is also rejecting that area around it. So we now have confirmation. How many confirmations would we have for the market pushing lower? We would have confirmation of the downtrend, which is 1. Downtrend. We have confirmation price below the moving average, which is 2. We have market rejecting the support, the resistance zone around these levels. So we have 3. We have pivot. We have bearish pin bar candles coming in. So that's 4. You have the market rejecting the 61.8 level. So that's 5. So you have 5 indications to send the market lower. What indication do you have in terms of barrier of entry to stop the market from going higher? And all we have is this support zone here. So we have one barrier of entry one barrier preventing the market going lower. So it is a 5-to-1 favor to the downside. These odds are already in your favor. So you already have a high probability trade for the market pushing lower. And you would have observed that on your daily time frame. You take the market down to your 4-hour time frame. And what are you observing now on your 4-hour time frame? You are observing here. If we look again with most recent price, we are finding ourselves in terms of the lowest point here. Highest point would be to your left still. So it's still within the downtrend. The main trend is down, but we have an active counter trend to the upside. From this active trend that we have to the upside, what's the level that we are going to utilize as our trend anchor and our potential anchor to the counter trend to the market moving higher? If this is a market highs that price created, this level here would be market potential anchor. And this level here would be market trend anchor. So when you find what is taking place now, you also have price pushing down against the potential anchor to the uptrend that could indicate a potential reversal to the highs. If we look and we try to identify 4-hour support and resistance levels, and we observe them here. The support zone is also within the same, or resistance, I should say, sorry, is also beneath the 200 period moving average. So we already have two barriers to entry for price pushing higher, right? In addition to what you have on the daily time frame preventing price from going higher, that's 5. You now have 2 more, that's 7. You have 2 positions here in terms of the 4-hour trend anchor. This is the same daily support that we saw, so this is still 1. The 4-hour trend potential anchor, that's 2. So you're now at a favor of 7-2 odds. That's still better odds for you, all right, to look at the market going lower. You have a doji candle coming in here, which is an indecision candlestick here in the market. So ideally, what would you be looking to do in this instant? Your entry to the market would be getting the market to break out below support and also to break lower than your potential anchor. So now you're looking for your potential anchor to be broken, right? Because you're looking at more barriers preventing the market from respecting that anchor. So we could anticipate to enter short at this level. Put your stop loss above that area. If you're expecting your potential anchor to be broken, we can look for the trend anchor to be broken too. So we can look to target down here. Increasing that same risk to reward that we just had on the daily time frame of 2, bringing it down to the lower time frame on the 4-hour, we now have a 4-to-1 risk to reward. But this is not where we're entering. This is the final stage of analysis. Now we go down to the entry time frame. And what are we observing now on our entry time frame? We now have the entry time frame also in a downtrend, right? The market is in a downtrend here. Price is also beneath this 200 period moving average. So we are now having confluence on the lower time frame in relationship to the daily time frame. We observe, we can identify that we have a trend taking place here. We have a confirmed trend also. They can put our trend line there. This trend line is also acting as market resistance. When you observe, now if this is a low, this level here is also your potential anchor to the market's trend. Right? Here, you would have your trend anchor. So from this position, you're anticipating or looking for the market now rejecting this support zone and pushing higher. You're already getting a doji candle followed by a rejection candle here, down a bearish candle. So you can look to execute your trade at the break of this 1-hour support line, because this is the pivot low of the market. That's a pivot point. So we can now execute our trade at this stage. Putting a buy stop trade, a sell stop trade, waiting for price to push down to confirm that level. You can now look at this trade and you can take your first target into the 4-hour potential anchor. You can put your stop loss above the trend anchor. You still have a risk to reward that is greater than 1 to 1 at one outcome. If you want to minimize your risk, then you can execute your trade and put your stop loss above the potential anchor. Because when we observe what is taking place here, what are the barriers that the market would need to get above to get you out of your trade at this particular stage? Right? So even if you use a 50 pip stop for this trade, you have, let's count your barriers to entry, right? Or your barriers to price pushing higher. You have 1, this trend line acting as market resistance, trend line resistance. Moving average also acting as market resistance. So that's 2. Pivot point and daily support. That's 3. This daily support is also with the potential anchor. That's 4. Daily resistance, I should say, sorry. That's 4. 4 barriers to entry, preventing price from going higher. So that's a trade that you want to take, irrespective of the outcome. So this is one trade that you are looking now to take. And you open the trade in that sense. And observe to see what the market did. Price came down to put you in the trade, move back higher. So you realize now the market broke one level, which would be observing price to push lower. It broke through one barrier, which was trend line resistance. But the market respected what? The moving average. And we can observe price pushing all the way down. So you would have had a 127 pip gain from this particular trade. All right? So these are just different tools that we can utilize to observe and to execute our overall trades in the market. So let's roll this one through just to see how the market operates. Now that price is coming down here, this is the impulse of the market. And now we're getting back price revisiting. So this is what? 4-hour downtrend anchor. Remember, this is the 4-hour trend anchor. Uptrend anchor on the 4-hour. Market respecting that level. So we could have easily come here and executed the trade, but you do not want to be. If you're trading with the trend, you can take that trade. If you're trading a counter trade, then you can take that trade. And you observe. So now that the market is pushing back and respecting the uptrend anchor in terms of the counter trend here on the 4-hour, let's observe to see where we can get another entry in the market, because we would have already done the analysis. We know everything we need to know based on what is taking place on the higher time frame. So if we look at this entire move all the way down here now, let's say this trade was a winning trade. So you would have had one winning trade so far. And you take your Fibonacci tool and you pick it up from the start of that impulsive move all the way down to the end of that impulsive move. You're seeing the market pushing above this 38. We're looking now at the market coming into the 61.8 level. So if you should highlight your 61.8 level now on the 1-hour time frame, and we are going to use that there. And we're looking now at the barriers for entry out of the market. Now, what did we use to execute this trade? We waited for candlestick confirmation. So what are we going to do here? Wait for another candlestick confirmation. This is what we're using in terms of sequence trading. We observe everything that we're seeing, but we wait for candlestick confirmation, and we ensure that our stop loss and our take profit is greater than 1 to 2, right? Or 1 to 1. So if we should roll this through, here we did not get a confirmation out of the market. Yes, we got that rejection candle out of the market there, out of resistance, but there was no direct candlestick formation here for you to observe or to take a trade. So now price is coming back higher. We're getting above, price pushed above the 200 moving average, but what happened here? No price acceptance. This now becomes what? A pin bar rejection. So this is a signal that we want to see, right? Remember, we did all those things earlier, where we look at the signals around support, resistance, and trends. This level is coming where? Around the trend, the moving average acting as resistance. This pivot point here was also acting as resistance. So now we can execute another trade to the downside below that pin bar candle. Where are we going to put our stop loss? Above the 61.8. So now we can go to a 55 or a 60 pip stop loss. Let's go about 60. And if we go to a 60 pip stop loss, then we are looking at least a 1 to 2. So we did 1 to 2.5 before, so let's do that again. So we are now looking at about 1 to 1.5. Now here, we're actually looking for the market to break out of the trend line, of the uptrend anchor on the 4-hour time frame. Why? Because we're looking now for all the time frames to push to the downside, to confirm price to the downside. So in this situation now, let's roll this through. We would have found ourselves in another trade. Now the market came all the way up, put you in the trade, but rejected here and hit your stop loss just above the market 61 level. Now, after the market hit your stop loss there, so you'd have had one trade win, another trade loss, right? So out of this now, you would have had what? 2 trades, 2 possible outcomes. What would be the outcome of these 2 trades if we were running a 2-trade sequence? This would be 1 win, 1 loss. How much did we win on this trade? 127. 1 win equal 127. How much did we lose on this trade? 1 loss equal minus 60. So your net on these 2 trades would be plus 67. So the outcome is still favorable to you at 50%. You still have a favorable outcome. So what I would want for you guys to do now is to continue practicing these. Put them into application, right? And I would challenge you to do a series of 5 trades. What I would want for you to do for me, what I would want you guys to do for me now is to, out of these 5 trades, or let's put it, come on, let's do 5 trades, right? And 5 trades, I want entry, signal, And this entry signal, let's use that as candlestick pattern. And you can use one of the candlestick or two of the candlestick or any one of them that we would have discussed, whether it's the inside bar, whether it is the engulfing, whether it's a pin bar or the doji followed by the next decision candle, whatever it is. So we need all of them need to be exact in terms of the entry signal, right? That's what we want to identify. Here we use doji followed by the next indecision, the next directional candle. Here we utilize pin bar, right? Each trade must have a minimum of 1 to 2 risk to reward, right? So that's two things. You can use whatever it is that you want to use for the analysis, you can utilize that. But I need to see reason behind the trading decision, right? If you want to do back testing, if you're doing it through back testing, I need to see screenshots of the daily to the 1 hour. If you're looking at 1 hour entries, if you're looking at 15-minute entries, then you can go to the 4 hour to 15 minute, or you can use a daily too. If you're looking at longer term entries where you're looking at the 4 hour for entry, then you go to the weekly and you make your way down to the 4 hour for entry, right? And that's how I want to see these trades. You can do that for me, and I will keep in touch throughout the week, and we can have another look at this. You can send them to me via email, and I will have a look at them, and we can go through them step by step ahead of the next class on Thursday, where we would be looking at the trend and wave strategy, right? So yes, we teach, you already learned the fundamentals and how you can execute trades and create high probability trades based on everything that we would have gone through throughout the entire course, right? Utilizing only the key support, resistance, and trends on the market, giving you additional confluence with a few indicators. You can determine that. And you can also, I will also provide you with a profitable strategy, right? So this assignment is really to see your willingness to follow through on the application of on the application of going through the process and taking multiple trades that resemble each other. That's what you want your trades to do, resemble each other. That's the process of sequence trading. That's the process of getting rich through trading. We must be able to trade in sequence, right? We are not looking at the dollars or cents. We're not observing that part as yet. The dollars and cents will be based solely upon the amount of money that you have in your account based on what you plan to start with. Now, when you decide on the amount of money that you plan to start with, if you want a guide as to how to apply the necessary risk to get the maximum outcome of your funds, then I can help you in that manner to guide you along finding the proper methodology and the proper principle to to determine your money management techniques that you would use, right? So for this, in terms of the trades that you take, these are only based upon the strategy in terms of analysis and entry and your risk to reward ratio. When we look at money management, that is something completely different. And that is what we will be looking at in the next class. And we will utilize the trend and wave strategy to indicate or to showcase money management and how we really apply that to our trades to ensure that we reap maximum benefits every time. All right. So we can bring this session to a close. If you have questions, you can easily send me an email, put them in the message, or you can send them in the chat box here in the session. And we can definitely have a look at that, right? So if you have a question, you can just drop a 1 in the chat box and give you a time to do that. Otherwise, we can bring the session to a close and we can get started on your assignment for the night, for the week, and we can look at that. I would love if you could get them over to me by Thursday or before Thursday's session, so we can go through and observe them properly. All right, so have a good night and keep practicing. That's the ultimate aim of the game, to practice. Practice becomes perfect. It's how we are able to generate consistent profit. This, we're not looking at EMA crosses here simply because this I only use one moving average here, right? So I only use one moving average, which was the 200 period moving average. So this has nothing to do with EMA crosses. EMA crosses comes into play when you have multiple moving averages on your chart. This is not the purpose of this moving average, of applying this moving average here, is to focus on using it as a guide towards a trend, using it as a guide towards support and resistance areas. When we approach crosses, that's something completely different. So that now I would suggest that if you want to learn more about that, then you can do the necessary research on that. I would not get into that. It is too technical and it is not necessary for the objectives that we're trying to get accomplished here, right? So all you want to do is to follow through on the guide and on the plan, right? And as long as you can do this, the entire aim is just to apply the principles and to follow through on the guide and the plan and allow the trades to materialize. And as long as you do that, the simplicity is key. Don't overcomplicate things, right? So I would say to you, for now, do not focus on the moving average cross or any of that. It is irrelevant to you, right? So you just want to be able to use it as a guide to the trend and as an area of support and resistance. Those are the two levels and the two things that we want to use them for. So if you look at the market here, in this case, if we look at it here, in this case, price is above moving average. So we can anticipate further movement to the upside. We also have a counter trend in place. Even though we have not confirmed that in terms of the trend line, we have confirmed that in terms of Dow theory analysis towards what is classified to be a trend. The overall market is still down. right? Rule of thumb, highest point to your left determines the direction of the market, right? If the highest point to your left determines down, highest point to your right determines highs. Based on all the data that you're looking at here, even if you look at this point here, you're still priced that's higher. So it is still down. If the market is here coming down, then this could also act as support and resistance. So if I should draw a line across that board, you can observe to see where that level is and draw the line. You can also identify in time that that level is often respected as market support and resistance. So we're not getting data beyond that point. That's what you can observe. So now it's all about observing to see what price does around there. Now the market did not respect it at all, right? So we got up higher and now it came back down. Prices back below that area. So we are back in the downtrend. Here, we're now looking at this being your potential anchor. Price respected it and rejected. Now this level here, which would have been your uptrend anchor to the counter trend, price respecting that too and pushing higher. But we are now rejecting the highs of the market. Now you find everything already down. Market rejected the price acceptance below the downtrend anchor there. Price also creating a new downtrend here, confirming the downtrend with this candle pushing lower than than the one just above. So we now have this area 1, 2, 3, 4, 5. So this level now becoming your downtrend anchor. So that downtrend anchor is also within the same area of support and resistance in relationship to the moving average. We can observe to see how the price is respecting those areas. Market is still respecting those areas. So would you want, so regardless of what it is doing, it is just a purpose is what you want to identify, the purpose of them. Indication of trend, and to use it as a guide for support and resistance for your trades. Now we are above it, we can anticipate the market to move a bit higher. Getting back below, anticipate further movement lower. All right, that's all you want to be doing. And that's why we don't use just moving averages alone. They simply move with price. You want to utilize your moving averages in relationship to market data in terms of your support and your resistance levels. So that's what you want to be doing. Do not overcomplicate your trading, right? So all I want you to see is just practice of the application of what we've got, of what we went through. You do this, that's all you need. If you're looking for the moving average for a different reason, then you can research on that, but that's not the reason of what I am sharing, the purpose of the moving average. All right? So we leave it there for tonight. All right, so if you have any other questions, let me know. And just remember, trying to get those over to me by Thursday. All right, so have a good night and see you in the live session tomorrow morning.